All right, everybody. Good. Well, it's great to come after that great talk about Bitcoin finance to now, together here make the case for DeFi on Bitcoin. So yeah, you've come to the right talk. So definitely have a seat and yeah, let's get going. So my name is Tycho. I'm the co-founder of Zest Protocol. But today I just kind of want to take you through a bit. Like, why would we want to be thinking about DeFi on Bitcoin? And, just maybe to clarify, right, DeFi is decentralized finance. Right? And to make the case for DeFi on Bitcoin, then I guess the first question is really, what is the case for Bitcoin finance, right? Why would we want to do such a thing, right? Like, we're all quite happy, hodling our Bitcoins. Why would we want Bitcoin finance? Why would we want to lend and borrow this asset, right? Which is so great and so secure. And then following from that, naturally we can then make the case. Okay, what is then the case for decentralized Bitcoin finance? Right. So what is the case for Bitcoin finance? Well, if Bitcoin is money, right, which is something that we all believe, then an economy needs to exist out there where companies and people have future earnings in Bitcoin. Right? People should transact in this and have future earnings. And if people have future earnings, there's something that they quite like to do, is that they would like to bring their future earnings to the present. Right? It's one of the great features of money is that it's a unit of account. And once you have a few years of cash flow, you can then borrow against that to invest in your existing business. And yeah, that's like, one of the things we really enjoy in our, civilizations today is that we can borrow against our future earnings and, we can have all these nice things. Now, then the question might be, okay, so who is currently doing that, right? This might sort of sound very futuristic and, who would be borrowing against their future Bitcoin earnings? Or who would participate in the Bitcoin economy? Well, it's mainly these three. Right, in ascending order of size. So starting with market makers, right, they're like the largest participant in something you could call a Bitcoin economy today. Right? You've probably all interacted with one. Right? When you buy Bitcoin on exchange, it's very likely that you bought it from a market maker. Right? So market makers move Bitcoin around really quickly between exchanges to ensure price stability and ensure liquidity, right, which is one of the great features of this asset. That we can buy and sell it at any given point in time. And they borrow Bitcoin in order to do this market making, right? For them, Bitcoin is a natural resource. They move it around, they earn more Bitcoin, and in that sense, they produce a yield. Now, the second one, right, that was just briefly talked about here on stage before as well, are miners, right? They very obviously participate in the Bitcoin economy because they have future earnings in Bitcoin, right? They earn Bitcoin. But their liabilities are in fiat. Right? And that creates problems, right? A lot of these miners were massively over-leveraged, right? They had to sell a bunch of their holdings, right, at the worst possible moment for all of us. And for them actually to borrow against those future Bitcoin earnings makes a lot of sense, right? They can basically, stabilize their asset-liability mismatch, and in that sense probably also get lower rates. Right? And then third, and that's really what this is all about, is like any company taking future payments in Bitcoin. Right? It's obviously really nice that we've managed to disintermediate banks with a peer-to-peer payment system. But if there's no way for people to borrow against their future earnings, right? If you're a shop and you take Lightning payments and you have a history of a couple of years of payments, at some point you might want to be able to borrow against that to maybe upgrade move to a new place or invest in the growth of your business. So having this kind of Bitcoin finance is going to be really crucial to the further development of the Bitcoin economy. Now then the question becomes, like, what is the case for like Bitcoin decentralized finance, right? Why would you want to potentially decentralize this? Well, I think it's maybe nice to do a quick show of hands. Like, who here has ever earned yield on their Bitcoin? No, I see some people no. I see a few hands. It's quite hard for me to see from here. Okay, good. Well, then you're probably familiar with this, right? Celsius owes users more than 4.7 billion. Crypto hedge fund 3 Arrows Capital goes down. We saw some some more. Oh, let me go to the next slide. Bailouts, right? So yeah, exactly. No, that's not what we want to see. That's not what we want to see. And that causes, like, that's not just bad for those companies, right? But this is bad for all of Bitcoin, right? Then we come to the big pain, which is this, all right? Yeah. So first, the Terra blow up, right? Obviously had not much to do with Bitcoin finance, but it basically created a lot of forced selling. Then 3 Arrows Capital blew up. And then we're all the way there at the bottom, where basically a lot of centralized Bitcoin credit like imploded, and a lot of these market makers, for example, went from 10 possible credit lines to 2 or 3, right? There's not that many left. And this basically, like, as trustworthy as some of these centralized Bitcoin lenders could be, like, they have some fundamental flaws, right? And basically those flaws look like this, right? If you're a BTC holder, right, that's us, and you send your money to a centralized lender, you send your Bitcoin there, it's in a black box, right? You don't know where it's going, you don't know who the borrowers are, no one has any idea what's happening. And what happened in May of this year is that basically a lot of these centralized lenders were all lending to the same borrowers, but they didn't know that. Right? So they thought they had an exclusive relationship with 3 Arrows Capital, and a lot of them thought that, and then all of a sudden it appeared that that relationship wasn't so exclusive, and certain diligence or certain information wasn't provided. Yeah, and then when things blow up, then you have a really big problem, and the Bitcoin economy has a really, really big problem. So what would a possible future look like? Well, that would be something like this, right? Bitcoin holders put Bitcoin in a contract, right? A pool contract that's publicly auditable, and from there it's lent out to these borrowers. And at that point, all the loans are on chain, everything becomes fully visible, and you can see where the Bitcoin goes. So hey, 3 Arrows Capital is borrowed from a lot of these pools. That seems a bit strange, right? And all these lenders can actually, do their proper diligence without having to kind of, take people for dinner and trying to figure out like who's lent to whom. And yeah, that's essentially what we're building with Zest Protocol, like an iteration of this, where anyone or a really professional credit underwriters can launch these pools to basically rebuild the system of Bitcoin credit to fuel the Bitcoin economy, and that looks somewhat like this, right? So we would have I could probably point with this even. Yeah, we have Bitcoin liquidity providers here. They put liquidity in the Bitcoin pool, then borrowers take that out on approval of a delegate that basically underwrites the loan. They act as an underwriter. And then there is a pool cover, which is essentially a junior tranche of the pool. So if there would be a default, that tranche gets hit first. And the pool delegates, they put money in their own pool cover. And it's fully public, it's fully clear what's happening. So these systems already exist, right? They've issued around 1.7 billion in USDC loans on Ethereum, and probably currently have around 15 to 20% of that lending market. And to kind of take it back, right? Now is really the time to go and build this Bitcoin economy, right? And we're in this phase where we have a lot of really highly creditworthy institutions that are entering the space to potentially lend to, right? And you're speaking to these market makers, like publicly listed companies, right? And at the same time, like, to get this Bitcoin adoption really off the ground, like, we want to see companies in El Salvador grow, and it's probably time to put our Bitcoin where our mouth is, right? Like El Salvador, well, maybe we should just lend to them, right? And then that will also lower rates for those companies, right? It's a quite clear case to make that a Bitcoiner would probably have more faith in the performance of a company in El Salvador than a bank, right? And in that way, you can really start creating an economy that basically exists on its own outside of all these financial institutions, right? As the original vision of Satoshi really was. So the time really is now. And there's ways that you can help fuel the Bitcoin economy, right? So we're going to be launching later this year in Q4 2022. The first pool on Zest protocol will be run by Maven 11 Credit here from Amsterdam and Credora, and they'll focus on like the most creditworthy borrowers in the market maker space. They've issued collectively, well, it's actually already more than 700 million worth of loans with 0 defaults through all this year on similar lending protocols. And yeah, an APY indication of say 4 to 6% in BTC is what these kind of really highly creditworthy borrowers tend to pay. And the announcement of today is that we're launching our testnet on the 20th of October, which is next week, Thursday. So people can try, people can come have a look, see how it all works, as the people here previously said, right? Do your homework. Yeah, so that's it. You know, join the community. Zestprotocol.com. Follow us on Twitter, and if you want to reach out to me, I'm at Tycho Onnasch on Twitter, or you can just go, you know, find me at the booth here downstairs. But yeah, I don't know if we have any time left, but it would be great to do some Q&A if possible. All right. So any questions? See a hand over there. Wait, do we need to get a microphone so that it's in the recording, or? Oh yeah, that's actually a good idea. So how does it work technically? Yeah. So good point. I was told to keep this, you know, simple for a general audience. So how does it work technically, right? So if you're a liquidity provider, if you provide liquidity, essentially what you do is you put Bitcoin in a hash time lock contract on the Bitcoin blockchain. And then we leverage the Stacks programming layer to then sign that this was you essentially, right? So I put Bitcoin in a hash time lock contract on Bitcoin. I sign on Stacks that this was me. And then in the next block, you get the LP token in a Stacks wallet, which is essentially like the receipt token for this. So that's how it works. What happens then under the hood is that a third-party swap provider comes in and performs a swap, right, of that Bitcoin in the hash time lock contract for a wrapped version of Bitcoin on Stacks. And then when a borrower comes, the swap happens the other side. But that part we can abstract away from the user essentially because of Stacks' unique architecture and unique features. Yeah. Cool, fantastic. I see a masked gentleman here or a masked person here in the front. Do you require KYC? So that's an interesting one. So this is a decentralized protocol, right? And different underwriters can basically launch pools, right? So underwriters might choose two types of pools, either a permissionless pool that anyone can deposit into, or a permissioned pool where only whitelisted addresses can deposit into, right? So these pool managers will basically have like different underwriting strategies. Some might work with, say, some more conservative borrowers, right, that would want to borrow only from KYC pools. Others are more, crypto DeFi native that, wouldn't mind. So the first pool, the Maven 11 Credora pool, will be a permissionless pool that anyone can deposit into. All right, just trying to. What is the biggest danger? Very fair point. No, that's what we need to know here, right? So what's the biggest, or what are the risks, right? Let's just kind of go through it one by one. So the main risk is credit risk, right? It's a loan, right? So and with any loan, it's possible that there could be a default, right? And that's why there is this sort of pool delegate model where all this happens on chain. You can see live on chain. Okay, what is the history of default of this pool, right? And that will directly impact the yield, etc. But yeah, in essence, default risk or credit risk, that's the main risk you're taking for which the reward exists. Question just there, yeah. Sorry, could you? I only heard. Yeah, so that's a good point. So currently, it doesn't need to come from the same wallet, right? So what happens is that the UI, you know, on the testnet you can see on Thursday next week, is you'll basically see an address. So we'll basically generate a hash time lock contract address to send the Bitcoin to. Then the UI basically just waits until that's confirmed, and then moves to the next screen where it's asked for a signing on Stacks. Those can be different wallets. Yeah, so these loans are directly against the balance sheet, right? Come again? Oh yeah, sorry, to repeat the question, good point. So the gentleman asks, are these loans under collateralized, right? And yeah, these loans are under collateralized, right? They are directly against the balance sheet of a borrower, which is, you know, that's the, like, over collateralized loans are essentially, you know, they're for speculation, right? That's what people are doing on Aave. They collateralize one asset, they speculate that their collateral goes up. If you want to borrow against your future earnings, then essentially your future earnings are collateral, right? But they don't exist yet today. So the borrowers in this protocol will also sign a master loan agreement, right? That enables enforcement, you know, in case of default or in case of missed payments, for example. That's right, yeah. On the borrower side, absolutely. Absolutely. These borrowers absolutely need to be KYC'd, right? Because they're going to take people's Bitcoin, right? So that, and they're entities, yeah, that need to be able to enforce against. So there's two things. So the question was, yeah. To repeat the question, sorry, I'm just engaged in this discussion. So the question was, okay, is there KYC? And then it's like, yes, on the borrower side, there's absolutely KYC. On the lending side, or who can deposit into the pools, there is basically two options. And the first pool will be permissionless pool, where anyone with a Bitcoin address can deposit into. But the borrowers, right, and that's very important, they undergo a KYC check. Yeah. So that's another good point. The question, to repeat the question, is there smart contract risk? Yeah, that's right. So we're trading off here. I guess in the centralized finance model, you have custody risk, right? Because, you know, you send your Bitcoin to someone, they can, you know, create a problem. And there is counterparty risk, right? You might not know who they're lending to. What happens here is that we reduce that and in essence trade the custody risk with smart contract risk. Now the thing is that with smart contract risk, you have increasing returns to scale, right? So the more that a contract is used, you know, the more clearly you can assume that it works. But yeah, for the first liquidity providers, like, they need to be very aware that there is such a thing as smart contract risk, right? As with any DeFi protocol. Fantastic. Any other? Thank you. Thanks very much.